In this video we are going to talk about top 7 ways to invest your money. So before starting this video, please like this video, subscribe and turn on the notification to our channel for future updates. For beginners, investing can be overwhelming because there are so many ways to invest. Many of the more esoteric investments, on the other hand, are best left to professionals. Complicated, leveraged or derivative investments such as futures and options, for instance, can serve a purpose but also carry a high risk of loss. There is a much more manageable range of investment categories to consider for the average investor, each of which can help an investor reach his goals. You'll get a good idea of the various risks and return characteristics of different investment types by discussing 7 relatively simple ways to invest your money. Number 7. U.S. Treasuries. U.S. Treasuries are at the top of the pyramid for investors looking for safe investments. U.S. Treasuries are investments backed by the U.S. government's full faith and credit. This means that payment of interest and principal on these investments is guaranteed by the government. This assurance can be met in a variety of ways. The government usually simply issues new securities to investors and uses the proceeds to repay existing investors. However, if the need arose, the government could use its authority to levy taxes or simply print more money. Treasury securities are among the safest investments in the world because the U.S. government has never defaulted on them. 3 main types are divided into U.S. Treasuries: bills, notes and bonds. The maturity of Treasury bills is 52 weeks or shorter, with notes maturing in 2 to 10 years. The bonds have maturities in excess of 10 years. Interest paid on securities in the Treasury is federally taxable but free of state tax. Treasuries can be purchased from a broker or at regularly scheduled auctions. Number 6. Retirement accounts. Retirement accounts are not investments in the traditional sense, but rather tax-advantaged accounts that can help you save for your long-term goals. Typically, money you put into a retirement account is tax-deductible, and until you take out the money at retirement, the funds within your account grow tax-deferred. Many larger companies offer a 401k retirement account, which typically includes a selection of mutual funds to invest in as well as tax advantages. Many businesses will contribute to these accounts on your behalf, matching a portion of your own contribution. An individual retirement account, or IRA, is a good option if you don't have access to a 401k at work. As individual accounts, IRAs make it possible for you to invest in almost anything you want, from individual stocks and bonds to mutual funds and traded funds (ETFs). You will not benefit from any company match, however. A Roth IRA is a type of IRA that has the opposite tax benefits of a traditional IRA. You will not receive a tax deduction on the money that you contribute to a Roth IRA, but after age 59 and a half you can pull your contributions and earnings out tax-free. Number 5. High-yield savings account. A high-yield savings account can be a great place to keep money that you need right away. Unlike a CD, there is no maturity date for a high-yield savings account. You are free to withdraw your funds at any time, although certain transactions are limited to 6 per month. High-yield savings accounts, like CDs, are insured by the Federal Deposit Insurance Corporation (FDIC). High-yield savings accounts have evolved to take business away from traditional banks because banking is such a competitive industry. When it comes to these types of savings accounts, you can usually get the best rates by using an online bank, which has lower overhead due to the lack of physical branches. While high-yield savings accounts online can pay 20 or more times the yield you can get from a traditional savings account, there are some disadvantages. Because they don't have physical branches, online banks have to rely on phone calls to communicate with tellers and customer service representatives. Making deposits can also be difficult, especially if you want to deposit cash. Number 4. Treasury Bonds. If your primary goal is to earn interest, you can invest in many different types of bonds in addition to Treasury Bonds. A bond is a promissory note from the issuer to the investor. In exchange for your investment, you will receive a stated interest rate and the assurance that the money will be returned at a later date. This promise is, of course, only as reliable as the issuer's financial strength. This promise is unbreakable in the case of Treasury bonds. Bonds issued by municipalities as well as corporations, however, carry the risk of default. In order to help investors measure the level of risk of an individual bond, many bonds carry ratings issued by outside agencies. Corporate bonds pay taxable interest, whereas municipal bonds pay federally tax-free interest. Also, in the state in which it is issued, municipal bond interest is often tax-free. Many municipal bonds carry outside insurance, providing them with AAA's top available safety rating and providing investors with peace of mind. Number 3. Mutual funds. Mutual funds are a type of pooled investment vehicle managed by a professional money manager. A representative share of the investments that the manager buys on behalf of the fund is owned by each individual shareholder. Mutual funds come in a variety of shapes and sizes, with investments ranging from the broad stock market in the United States to Indian industrial companies. Mutual funds have a variety of investment objectives, ranging from aggressive income growth to capital preservation. Mutual funds are a good choice for investors who want to own a diversified investment without having to buy dozens or hundreds of individual stocks. They're also a good choice for investors who want their money managed professionally. Fees can vary dramatically between funds. Some funds charge a purchase or sale fee of between 1% and 5%, while others are no-load and free of such charges. Every fund has an annual expense ratio, which is the amount charged to investors to cover the fund's ongoing expenses. These costs can amount to 1% or more per annum. Number 2. Robo Advisors. Robo Advisors are a newcomer to the investment scene, combining professional management with convenience and low costs. A Robo Advisor will analyze your risk tolerance and investment objectives to create an investment profile through the use of a questionnaire. Your funds will then be allocated to a predetermined exchange-traded mutual fund portfolio that matches your questionnaire results. Low annual fees are charged by Robo Advisors, typically around 0.25%. They also have low, sometimes as low as $0, minimum investment requirements. The trade-off is that there are still somewhat limited investment options, and portfolios are somewhat generic. Robo Advisors can be a good option for new investors or those looking for a low-cost way to invest. With some Robo Advisors offering a higher level of service for a higher fee and others incorporating more active management, the field is still evolving. Number 1. Real estate. Although countless reality TV shows have emerged to be flipped by representing real estate as a short-term investment, real estate is traditionally regarded as a long-term investment. Real estate can be used as a growth vehicle, a source of income, or a combination of the two. For example, rental income can be generated by an apartment building, but the property itself may also appreciate in value. Single-family homes are typically designed for long-term expansion as well as the creation of a home for a single family. A second home, on the other hand, can serve as both a personal vacation home and a holiday rental. Investors who do not want the hassle and dedication of buying their own homes or buildings may choose trusts for real estate investment, or REITs. These investments are similar to mutual funds, but they trade on the stock exchange like stocks and can be purchased and sold at any time. In accordance with the rules of the fund's prospectus, portfolio managers invest the funds in various types of real estate investment. So that's it for today's video. What do you think of our list? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button and turn on notification before you go. Thanks for watching.